We are moments away from the start of trading. This is Bloomberg Open Interest. I'm Matt Miller. We're looking at futures that are doing nothing, but after what really was a big day yesterday in markets. I mean, we closed at, I think, 6,115 on the S&P 500 after not really getting much of anything at all on tariffs from President Trump. NASDAQ futures are just as unchanged. Russell 2000 futures up about 0.5%. The opening bell on the New York Stock Exchange, Karman Space and Defense, because they had an IPO. Congratulations on that. But I think far more interesting is Saturday Night Live, along with a range of cast members and apparently some of their children as well, ringing the bell for their 50th anniversary. We have been thinking about Gilda Radner today. Wish she were here. In terms of stocks, she would have made so much money. Stocks are up, the S&P, like 6,000% since 1974. And let's take a look, Katie, at what they're doing in this moment in the first 40 seconds of trading.
We've also been talking a lot about Chris Farley, clearly SNL on the brain right now. And that's maybe more exciting to talk about because not too much is going on in the market right now. This entire week has been a bit of a head scratcher when it comes to how to trade this economic data. Hot CPI, hot PPI, a huge rally yesterday. Now we got very, very weak retail sales data, and you can see the S&P 500 rallying a little bit in response, up about 0.1%. Same story if you take a look at the NASDAQ 100 and your big tech names, higher by about 0.1%. The small caps have been particularly interesting this week. Of course, we've had this big bond market rally develop just in the last 2 days, and that's being expressed in the Russell 2000 as well. Currently higher by about 0.4%, just about a minute and a half into trading. But let's get specific here and let's talk about Intel. We were talking about what a huge week it's having, its best week since 1982, on reports that the U.S. government is possibly getting involved with a plan that would involve both Intel and TSMC. We also heard from J.D. Vance earlier in the week talking about how we're going to be producing these American-made chips. All of that is adding up to a 28% gain for Intel this week, Shonali.
Yeah, pretty significant story and a lot of questions still on what's ahead, but a nice run this week. Not so nice of a run here for Moderna today, down 5% as the market opens. They reported a quarterly loss due to waning vaccine sales. The company is struggling to grow its business with plans of more than $1 billion in cost cuts this year. They've been posting a string of quarterly losses, really, Matt.
All right, yeah, we're paying attention to mRNA today as well as DraftKings. Those earnings beat expectations because probably of the betting that you've been doing, and it raised its sales guidance, overcoming concerns about the sports betting market. We could see those concerns come back, right? We were talking with Vlad Tenev yesterday.
That's
from
exactly
Robinhood.
Where I was going to go, because you think about the events contract ambitions that they have. The Super Bowl for 2025 didn't exactly work out for Robinhood, but we know they have big plans. You have to wonder whether that's going to sort of take some territory away from DraftKings.
You know that I have so many feelings about this, right? Because
Tell
this is a state-by-state market. In fact, I'm so close to New Jersey in my house that if I'm betting in certain parts of my house, I can't bet.
Wow.
So
interesting.
But if you have the CFTC saying whatever, this is all just an event contract and we're fine with it now, then does the moat go away for a place like DraftKings? And then a place like Robinhood could work with a place like Kalshi, and then all of a sudden you can bet in different places.
Could be a totally different landscape. And this is a landscape that has changed a lot in the past couple of years.
Well, and for Shonali, it's worlds colliding, right?
That's true.
With her crypto coverage and markets coverage and NFL sports betting problem. Let's, though, get back to the broader market picture. We still have Bloomberg's Jess Menton with us here on set, and we can talk about some of the individual movers, but I want to get just a check on how the markets have done under President Trump. He had so much in store for us in terms of tax cuts and tariffs and deportations and deregulation. So far, there's just been a lot of talk about tariffs without really doing much.
Well, on China.
Oh, okay.
We got
on China. So what have we seen in terms of the Trump effect, the Trump trade so far, 3 weeks into the presidency?
Well, I like to look at positioning specifically because that can tell you kind of what systematically and then discretionary funds and how they're positioning. So still it's hovering towards those records that we would have seen in a bit stretched there. But when you don't have actual policy going through, tariffs don't necessarily need Congress to approve a lot of that stuff. But then there's other things on the tax front that a lot of portfolio managers specifically would have to position decision on. So they really have to wait till things actually take place before they start changing that. So it's interesting yesterday because you saw the S&P 500 trading just below its all-time high. It actually hit that earlier in January. But then I was like to look at what the riskiest corners of the market are doing. So if you look at what's happening with Goldman Sachs basket of most shorted stocks, that was actually up more than 3% yesterday. And then also they have a separate basket that looks at non-profitable tech. So those are younger companies that need more funding, not necessarily the big tech type names like when you think about NVIDIA or Apple, something like that. But that also was up over 5% yesterday. So that's telling you that the riskiest parts of the market were rallying yesterday on the back of basically not getting a ton of news there about the timeline of tariffs.
And just even more pain for those short sellers. But Matt, you make an interesting point about where we are on the Trump trade, and something that I've been thinking about. This is actually a theory that I stole from Stephanie Flanders of Bloomberg News, that it's that he didn't pursue tax cuts first. He went with the sort of market unfriendly policies.
I would totally agree with that.
In tariffs. If he had pursued tax cuts first, it's possible we would be having an entirely different market conversation right now.
Well, but he can't do tax cuts with an executive order.
Right.
So he went after the things that he could achieve with just the stroke of a Sharpie.
How many times have you heard tax cuts? In fact, you've seen some parts like the carried interest tax be disputed. So you've seen kind of the opposite here. You know, Jess, the other thing I'm kind of fascinated by here is the push-pull with the Magnificent Seven, because if you look at performance this year, it's pretty meager. It's only up as a group less than 2%, 1.2%.
Pedestrian,
and it's really Tesla and NVIDIA still driving that. And NVIDIA, of course, we know has been pretty sluggish all year, too. Is that going to be what investors are looking at to drive stock market performance this year still?
Well, Goldman Sachs, David Kostin, they like to put out whenever they're analyzing the transcript scenario analysis. And so far, when you've seen the mentions here, AI is still in the top 3, but it's more tariffs are dominated on the calls right now. And then after that, it's the U.S. dollar, just given that it's been so strong since the end of September, but we have seen it pull back, come down from some of these technical levels of late. But that's going to be an interesting thing that Bloomberg Intelligence is especially focused on moving forward. But what's interesting just from earnings in general, when you're thinking about the Magnificent Seven, of course, the base over base effects, we have seen some of those growth estimates slow here, but tech in general is still carrying those estimates, and especially when you're thinking about other sectors like communication services, obviously Mag 7 companies housed in that technology, and then of course discretionary, because that's where Amazon and Tesla are housed as well.
Yeah, it's a good reminder that when we talk about the Magnificent Seven at the sector level, we're not necessarily just talking about tech. But let's talk about the earnings picture overall, because there was some really interesting data out from Bloomberg Intelligence earlier this week, taking a look at the companies that actually beat their estimates, not necessarily getting rewarded in the stock market like you might expect.
That's right. So you can look on the dashboard here. So if you're looking at just for companies backward looking, though, for the fourth quarter that are beating both on EPS and sales estimates, right now the average of them being actually rewarded here, it's a lot less than what you would expect them to see. But what's interesting is it's more companies what they say about guidance. And of course, quarterly guidance, if you're looking at that, only about 25% of companies give quarterly guidance, and a little bit around, maybe around 60% of companies give out annual guidance. And it's mostly tech as well as consumer discretionary. So when you're looking at that, it's actually companies that are beating on EPS and sales for guidance specifically. They're being rewarded by the second most. It's actually over 6% right now within a day of reporting relative to the S&P 500. So that's the second best since basically the data is being compiled since early 2020 there. But if you're looking more backward looking on what they're beating for the fourth quarter, not getting rewarded as much handedly there. So really keeping an eye on what's happening with the guidance right now.
Now, let's go into some of the specific earnings as well, because I think I'm pretty fascinated by some of the movers under the surface. Roku, for example, today we're keeping an eye on. You know, when we're thinking about TV streaming, it's interesting to see them come back this way.
It's interesting, too, because that stock's down actually 80% from its all-time high in July of 2021. And I feel like when we talk a lot about these size and scope, some of these sort of pandemic-type, darling-type shares here, but actually that revenue growth is what was easing some of the slowdown fears. So Bloomberg Intelligence's Geetha Raghunathan was talking about how some of the concerns there when you're looking at what's happening with revenue, that was quelling the concerns about an ad slowdown. So that's what she was looking at too. And if you're just looking at the commentary right now, what they're talking about with those advertising activities, specifically for the fourth quarter, those were faster than expected.
And I do want to point out Moderna as well. Moderna actually halted for volatility right now, had been down pretty mightily after reporting a quarterly loss due to waning vaccine sales, a canceled manufacturing contract, but right now it had turned positive. Now it's halted for volatility volatility. We're going to continue to monitor that one.
Yeah, no, it's incredible. You're seeing a lot of intraday stock volatility more than the index level volatility. In addition to earnings, 13Fs are also flowing in. I'm pretty amused by what we've seen out of not a hedge fund's 13F, but NVIDIA's.
Right, and specifically SoundHound. So I know this is one of Tom Keen's favorites that he always likes to talk about when I bring it up.
First of all, it's a great name, SoundHound.
It is.
And secondly, let's just repeat that. Because when we talk about 13Fs, traditionally we're talking about hedge funds.
They're also
right?
backward looking, by the way, right?
Okay.
They are.
But just so that viewers understand, we are talking about NVIDIA's 13F right now.
Yes.
Jensen Huang's hedge fund.
Yes.
And especially because this is the day, so after the bell, we're going to get more information specifically from hedge funds, but we're starting to get some news out here, and specifically because we don't get it until 45 days once the next quarter has started, so this is for the fourth quarter, but specifically if you're looking at what NVIDIA is talking about in its 13F filings, it's actually disclosed that it added stakes to 2 other firms, but actually it sold off 3 of those, and SoundHound is one of them. So if you look at SoundHound, SOUN is the ticker symbol, down over 30% on pace for its worst day since June of 2022. Of course, SoundHound is tied to the AI type of themes that we talk about here. So another one was NanoX that NVIDIA revealed that it had sold stakes in, as well as Server Robotics.
Jess, great to have
Nebius
you.
also, by the way.
What is it?
Nebius.
Nebius. Also
Also on the rise with a little appearance there.
Not nebulous.
Jensen's hedge fund, as you
Jensen's
said.
hedge fund, yeah.
Jess Metten, thank you very much for that. Jess Metten giving us an update on what's going on in the stock market today. Looking at the bigger picture, I was sort of typing away here to figure out.
Yeah, you looked busy.
How much would you guess the S&P 500 has appreciated since the first episode of Saturday Night Live, which aired on October 11th, 1975. And I told you it was about 6,000% already in terms of the price appreciation. What about
In total return?
total return?
Shoot, I have no idea. A gazillion?
26,638%.
That's not
according
too
to
bad.
the Bloomberg comp function.
I would
What
like-
does that say about SNL?
What does that say about?
You know, do you guys watch? Do you watch SNL?
I do.
You do.
I do.
you-
I also do, yeah.
So, okay, people are still watching it, which I think is great. I
Not-
loved it when I
not
was a kid.
live.
You mentioned Chris Farley, Gilda Radner. Obviously, I love Chevy Chase and Dan Aykroyd.
Guess it's refreshing that some things stay the same.
Yeah.
Yeah. Very good. Okay.
All right.
Ringing the bell there at the NASDAQ market site today. Coming up, Wall Street bets on high rollers after big MGM, the big MGM earnings win, to which Sonali may or may not have contributed. Details in Top Calls. This is Bloomberg. All right, we heard earlier this hour from the United States Vice President J.D. Vance talking at the Munich Security Conference. We are now talking to Ukrainian President Volodymyr Zelensky there. Francine Lacroix is moderating a panel that includes U.S. senators. Let's listen in.
Сьогодні ми не говоримо про будь-яку мирну угоду. Хоча, скажу вам відверто від себе, на жаль, війна довга, яку розв'язав Путін, і дійсно ця...
So Zelensky there speaking Ukrainian. We'll get you a translation of that when we can, but just wanted to give you a heads up that that's there, and we will continue to bring you headlines, of course, from that panel as well at the Munich Security Conference. There is a lot going on in markets. Certainly yesterday was a big day for markets, if not a big day for tariffs. And today we're looking at an S&P 500 that is showing some modest gains.
It's a little bit higher. I am interested to see how the trade develops because you think about so far the opening weeks of 2025, Fridays have been weak. People have been really cautious about holding risk into the weekend. You usually see the S&P 500 decline over the past couple weeks. Same thing too on Mondays. As we learned earlier this week, of course, it was Wednesday that was the best day. So we'll have to see what changes between now and 4 p.m. But we have to talk about Moderna. As we have been saying, we're in the never-ending earnings season, and Moderna shares, they were in free fall earlier. They've since reversed. That's after the drug maker recorded another quarterly loss, thanks in part to a canceled manufacturing contract. Sam Vazeli of Bloomberg Intelligence joins us now. And Sam, this is a really interesting story, of course, very fluid right now when you think about what's going on with shares. What's your read of what we learned this morning when it comes to Moderna and the path forward?
Yeah, I mean, look, I've been watching the share price doing what you were just referring to and being a bit at a loss, looking at the story there as to why. I mean, they've guided for 2025 before, and they've maintained the guidance. The costs are in line with what they said at the beginning. I mean, of course, nobody knows. I mean, if you look at their guidance, revenue is forecast to be between $1.5 and $2.5 billion. I mean, that's $1 billion gap between the two. So, but none of that is new. And there was this thing about their norovirus vaccine maybe being halted by or at least put on hold in terms of the trial because of one case of something called Guillain-Barré syndrome, but they explained that pretty well. I don't see that as a major reason. So the volatility, honestly, I think it's a lack of understanding of all these little nuances, but nothing really new here.
All right, well, but still fascinating, especially considering the confirmation of RFK Jr. as the U.S. Health Secretary yesterday. Sam, thanks for helping us look at one of the stocks that's moving there. A lot of stocks moving under the surface of this market, which looks relatively unchanged. And as I said, we have gotten you a translator here so that those of you who only speak English or not, at least not Ukrainian, can understand Volodymyr Zelensky. Let's listen in to this panel at the Munich Security Conference.
In backstage, no. This is important for us to understand that that Europe, in fact, has been making a contribution to our fight, and on the U.S. part as well. So I already extended my gratitude to our U.S. friends, American friends, on the part of the Congress, on the part of the executive branch as well, for them to have been supporting life of our Ukrainian society. So this is what we're talking about. With regard to my meeting with American colleagues, we have had a lot of meetings, to which I'm very grateful and we're very happy. We had a good talk with President Trump. We supported this plan to invest in critical minerals in Ukraine, and I've been saying this many times, that we need to protect our resources. Why? They need to be protected because, well, let's be pragmatic. We're not talking about security only. Security of Europe is number one priority, and people and human life is a priority, but we also must be pragmatic. We're talking about protecting our resources to prevent our occupants from being able to put their hands on our resources. We need to protect our resources, and for this, so bottom line, gonna be short.
But because it's very necessary to explain all the details. That's why I said that, yes, we have to save these minerals. And those countries, we are thankful to all the support, but those countries who will support us and who will save this, of course, they will have priority to invest in it. Invest in it, because we need jobs and investment, and then we will divide profits with one or another partner. So that was very important. Save it and don't give to North Korea, maybe China, I don't know whom Russia will and want to give it after occupation. We need to save it, critical minerals and a lot of different things. That's my message. I was happy that Americans, they came, the Secretary of Treasury, he came to Ukraine directly to Kyiv. It was his first mission, and it was exactly to Kyiv. I was very thankful to him, and he brought the document, and the document was on my table. I said that our lawyers will learn it, and then with some advices or some changes, we'll come back. It's about investment. It's not security document. It's memorandum between two sides. And I know that I will have meeting with Vice President. I don't know. I mean this evening, but I'm here till tomorrow. I can meet evening, morning. Doesn't matter for me. Like President Trump said. So you can come when you want. I'm always in Washington. I can say to Vice President, you can come anytime. I'm here in Munich, and I'm ready. You know, really with pleasure. I'm ready to meet. I'm not ready to sign everything, but to meet. Yes, I mean that I will not sign. The ministers will sign, but they will sign right memo how to save.
Можливо, якийсь меморандум, щоб добре мати справу з цими критичними мінералами, корисними копалинами. Так, шановний президент, розмова між Володимиром Путіним і президентом Трампом заохочив Путін, як ви вважаєте? Як ви бачите, це якісь риски є для США також, чи є якісь риски небезпеки для США після цієї розмови? Це питання. Вони говорили по телефону. Дуже коротко. Це риски для вас?
For the US.
Risk? What is it?
Vladimir Putin and Donald Trump have spoken on the phone. You were briefed on the conversation. Is this a risk for yourself, of course, but also the U.S.?
Phone calls between Putin and Trump was risk for United States. I think not risk for United States. I think for Trump, because he's stronger than Putin. I think so. I think risks for all the world, because the priorities. We have much more risks than risk for the United States, with all respect for all of us, with all the big guys. And I think it's very necessary. As I said at the very beginning, I had good conversation with the President Trump. We had some phone calls, and he had phone call with Putin, and he said to me, I think that Putin, that he wants to stop the war. I said to him that he is a liar, and you can yes, you can count on it. I hope that you will pressure him, because I don't trust him. We had such conversations with Putin, direct conversation about ceasefire. So just ceasefire, we don't need just ceasefire. This is global problem. So we had ceasefire. It was my direct decision. And we made a decision that it will be ceasefire and exchange all the prisoners. And he didn't change all the prisoners. Yet we've been very happy. That was first step when we brought home more than 100 guys to their family. It was very necessary between us. Even because of this one reason, I had to come to France in 2019 and bring back people. But he will not just, ceasefire and that's all. That's why I said to President, yes, but I think phone calls are phone calls. Let's forget about it. I think what is very important, the meeting, not to make any decisions about Ukraine without Ukraine. This is principal position we will never accept it. And when I said that we will never accept, I'm not speaking just about me. I'm speaking about all our people, all our nation. People will not stop. We will give him pause. Without real security guarantees, we will give him pause. I don't want to, be those person in the history who helped Putin to occupy my country. I don't want it. And that's why I will never do it. I will never do it. And it's very important for me to pressure Putin, put all the sanctions. I think President Trump is ready to do it. He has all this power to do it. That's why I wanted very much to come to Washington any day this century. And to come to Washington, and I think we need very much to make the common plan of civilized people and to share all these things with our friends and with the help of our friends of Europe. It's very necessary not to lose this unity. I'm so proud that we are part of such strong Europe. And I think this is important, very important, not to lose this unity. Before this war, maybe not too much things, by the way, which this war made positively. That unity between the United States and Europe, that's what this war brought. And Putin scared it. I think during the last 20, 25 years, I don't remember how many years he's in Kremlin. So, this is the first time when the unity could pressure him and he couldn't occupy us because of this unity, because of our people and soldiers, of course, but because of this, not to lose it, and now to make a deal without us or without Europe. It's not a good idea, and I hope that President Trump doesn't have this idea. I count on it very much. I think I answered on 10 next questions. Sorry.
I have 100 questions, but to the senators.
Yeah,
and maybe
to the senators, please.
To the senators, and maybe let's start with Senator Graham. Are you comfortable with a world in which the president seeks to do deals with authoritarian leaders like Putin or even China before consulting with longstanding allies like Germany and France?
Yeah, I'm very okay with Trump talking to Putin. He talked to him. What I'm not okay with is the world losing deterrence. Why are we in this war? Okay, they invade in 2008 Georgia. They invade in 2014. They're back at it again. So rather than worrying about who Trump is calling, why don't we talk a little bit, how the hell did this happen? I've been coming to this thing for 25 years. John McCain.
All right, Lindsey Graham there speaking in Munich at the Munich Security Conference. Francine Lacroix moderating that panel with some other U.S. senators, as well as Ukrainian President Volodymyr Zelensky, saying he's ready to talk. He's in Munich. J.D. Vance is in Munich, and he will talk to him anytime, morning or night, he says. And that is a big change from where we were this time last year. Certainly that was a big change from where we were at the end of last year.
Absolutely. And you think about some of the headlines that we got from Zelensky just now, just to read some of them, saying that we need firm support from the U.S., from Trump on our side. Ukraine also needs to protect its minerals from Russia, and Ukraine does not need just a ceasefire here. So this is a quickly moving situation. And Matt, to your point, of course, a lot has changed just in the past couple months.
Those minerals are a key negotiating tool at this point, isn't it? And on top of that, this is not just about Ukraine. It's so much about Europe as well. There's an article in the Financial Times overnight about just how much Europe has been left reeling. It cited multiple officials from various European countries wanting just this, for Ukraine to also step up and push the U.S. to be more involved with everybody and not alone.
Absolutely. And you think about what we heard from J.D. Vance just an hour or so ago, some very harsh words for Germany as well, which is facing its own election in just a week's time. Meanwhile, we go back to the U.S. and we go back to these markets. We're about 30 minutes into this Friday trading session. You can see a little bit of a lift on the S&P 500 right now, 90 minutes out from weaker than expected retail sales. That lift also coming through in the NASDAQ 100 and in the bond market as well, where a lot of the action has been this week. Your 10-year yield currently lower by about 5 to 6 basis points. Let's try to put everything together now with Tom Becker. He is lead portfolio manager of the BlackRock Tactical Opportunities Fund. Tom, it's great to have you with us, and we appreciate your patience here. Let's talk about what we learned this week. When it comes to the economic data, we know that inflation is still a problem. A lot of question marks about the consumer, and then you put that together with what we're seeing on earnings. A lot of idiosyncratic stories. It's very difficult to paint with a broad brush here. Where are you finding your opportunities?
Morning, Katie. Thanks for having me. Happy Valentine's Day. I think we got some interesting data today with the retail sales. Probably a give back from the Q4 strength, but also some of the disruptions I think that people are noting on the weather in the Southeast and the LA fires. We've done some analysis about how some of these shifts in climate disruptions impact both growth and inflation. And I think it's pretty important here at this juncture as people are trying to kind of discern, which way the economy's heading. I think this temporary fall off is kind of the disruption, people having a tough time getting to the stores, the fires disrupting kind of the second largest city in the U.S. We typically see a rebuild, kind of a swing back 1 to 2 quarters out. So expect some of this activity to kind of come back in the spring and summertime, particularly in LA, as you start to see some of the insurance funds flow in and rebuild activity take place. There's another element to it as well, which is kind of the increased number of these storms and disruptions. Here in California, we're seeing 20-30% rises in insurance premiums for households, for businesses. And though those aren't a big share of the CPI basket, we tend to see over time they get passed through in markups. So restaurants have to raise their prices when they get a bigger insurance bill, warehouses, office buildings. And so there's this subtle kind of undercurrent of high services ex-housing inflation that we think is being underappreciated by the market, by policymakers. It's sort of a multi-year dynamic that's happening, and we think it could keep inflation high.
Yeah, I think that this is a very significant moment because you have investors more and more keeping an eye on every piece of data, not just the macro, but also surveys like University of Michigan as well. At the end of the day, between what you're seeing across data and what you're seeing from the earnings reports from these companies as well, how important is the U.S. consumer to hold up the market at this juncture, especially because at the end of last year, you did see a consumer trade really come back into the S&P 500 and be a big part of what broadened that trade out?
Yeah, great question. I think the consumer is going to be the anchor of kind of consumption in the U.S. economy, just the math of how, big a part the U.S. consumer is. We think when you look at the payrolls data earlier this month, you're seeing very strong wage gains. You're still seeing kind of a very strong run rate of employment growth. That's putting money in consumers' pockets. We're seeing signs that consumers, spent a lot of money on durable goods in Q4. That's usually a positive sign. And so overall, we see kind of the U.S. consumer acting as though they've acclimated to kind of this high nominal activity. They're spending kind of the savings rate's pretty low. They're spending out of their income. And we expect the consumer to remain resilient.
Tom, I want to talk specifically about the fund you manage, specifically the BlackRock Tactical Opportunities Fund. I see tactical and I get excited because that implies that, you're opportunistic here. And I see in your notes that you recently added to your short 30-year Treasury positions. And we know that the long end of the Treasury curve has been all over the place, specifically, too, in this last week, currently to the downside when it comes to yields. Talk us through that position. What is the base case when it comes to the long end of the Treasury curve?
Sure, Katie. So tactical for us is kind of the 1 to 2 quarter horizon. On that short, long end, I think what we've seen at the beginning here of the new administration is a desire to kind of keep the status quo on how many treasuries are being issued. So we had the QRA last week, Treasury Secretary Bessent kind of, taking Yellen's playbook and extending it, no expectation of increased supply of long-run treasuries. We think as we get into the coming quarters, some of the fiscal policy that's likely to come out of the administration in terms of TCJA, as well as additional tax cuts, that's going to put pressure for additional supply into the Treasury market. There's another unanticipated element, which is the balance sheet of the Fed. So expectations a couple months ago were that QT was going to cease and that the Fed would then be rolling the balance sheet, buying more treasuries, kind of a bigger source of demand for that market. They released a paper at the end of last month indicating that they think they have a lot more runway. Some of the speeches by some of the influential policymakers like Lori Logan have pointed to the fact that they may want to shift the composition of that balance sheet. And so overall, we see kind of this underappreciated QT going for longer element, not yet really in market pricing. And add to that the strong inflation data we got this month. We think Fed cuts kind of here in the first half, that's a little bit too much of aggressive pricing.
Tom, do you mean to say that we may be in for some sort of Operation Twist again?
Reverse twist, Matt. Yeah. So they haven't done that. They've done a number of QEs, a couple QTs, and one twist. I think when you read some of the speeches recently, there's a desire to have the balance sheet look more like the overall Treasury market, whereas right now it looks like it's pretty long in duration. They're holding down the long end of the yield curve. And so reinvesting kind of into the front end where the Treasury is issuing, that would naturally kind of release some of the demand at the long end and do a bit of a reverse twist.
What do you think about gold continues to hit record highs? And we had a story on the Bloomberg terminal yesterday about a shortage of physical gold available for delivery in the U.S., really in the West. Do you look at the precious metal as a good hedge? Do you worry about the mismatch between futures and physical?
We don't invest in gold directly in the portfolio, but I think that dynamic in gold points to some uneasiness about the fiscal trajectory and how much issuance there is, kind of the unipolar moment for the U.S. dollar. We think that global investors are looking for alternatives. Gold has been one for decades and centuries. That makes sense to us that kind of as fiat currencies maybe come under a little bit of question or pressure, that people are looking for alternatives. And I think that can explain maybe some of the gold rally year to date.
Well, if you don't invest in gold, I'm not going to ask you about Bitcoin. I want to go back to the equity market, though, because following up what you're saying about potentially a reverse twist, maybe the long end gets released here, how does that translate through broadly into the equity market? We saw a lot of fears about the danger zone when it comes to 10-year yields. If we do see that release, we do see 10-year and 30-year yields go higher out at the long end. What does that mean for risk appetite in the equity market?
Yeah, I think it's a question of kind of cash flows versus multiples and discount rates. So higher long end yields, that should put pressure on multiples, and the multiples for the S&P are quite high here. You have juxtaposed that to foreign markets where central banks are more inclined to ease. They're concerned about the impact of tariffs on their economies. Their currencies have weakened. You're getting a little bit of a dynamic of tighter financial conditions in the U.S. this year and maybe a little bit looser in foreign markets. That wasn't the case last year. The Fed cut 100 basis points. It tapered QT. We think this year there might be a little bit more tension coming from the monetary side and keeping financial conditions in the U.S. a little bit tighter compared to foreign markets.
Tom, we thank you so much for your time today. Happy weekend to you. That is Tom Becker of BlackRock.
Happy Valentine's Day, Tom.
Happy Valentine's Day. So much going on in the world. We forgot about love. And anyways, we're going to go back. Bloomberg's Francine Lacroix, remember, is moderating a panel at the Munich Security Conference with Ukraine's president and U.S. senators, including Lindsey Graham and John Cornyn. We're going to continue to monitor the panel. And in the meantime, you can follow it on Live Go on your Bloomberg terminals. And coming up next, we're going to speak with Jose Minaya. He's global head of BNY Investments and Wealth, about his new post and what he expects for markets into the year. This is Bloomberg. Now, according to BNY, markets in 2025 will be defined by competing narratives of inflation risk versus growth upside. And as we've been saying, that's according to the global head of investments and wealth, newly joined BNY. That's Jose Minaya, joining us here on set. And what a great week to talk about this dynamic, because of course, inflation really did surprise earlier in the week. By the end of the week, you had investors shrugging off some of the pain with an eye on PCE, the Fed's preferred gauge of inflation next. How much does inflation still worry you?
You know, it's interesting. I think it's a little bit of like kind of back to the future. I think I was on a Bloomberg TV a little over a year ago when we were in Davos, and my storyline there was, hey, I think we're going to go into a soft landing. I made a bet at the time that there'd be no rate cuts, but we still be, having inflationary pressures.
Wait, what did you lose?
I lost $10 actually. Lost $10. I did. I bet another. I bet another CEO, but I was kind of happy to make the bet. I was in the money for a while there for the year, but the narrative there, it's not that different this year, right? I mean, you've got pro-business kind of administration. We're expecting constructive markets. Inflation is still sticky. Uncertainty is as alive as it was last year. Where the
pro-business narrative is certainly different, don't you think, from
that
time last year?
Yeah, because last year when I said soft landing, it was like, really, who are you kidding? Like, there was a lot more concern. There's a lot more optimism, right? The word, U.S. exceptionalism is kind of a trend. It's about growth today. If you think about our fiscal situation, even there, what the administration is looking for is more towards a growth mindset to try to get out of it.
So what's the bet for this year? There are investors pushing out their rate cut expectations. We're looking at now, there is one rate cut priced in as early as September. That was December, earlier just this week. Do you think one can even get in?
Again, and I'm probably in the minority here. I don't really see cuts again this year, largely because I think we're going to continue in this environment where we're going to be pushing up against inflationary pressures. The stock markets are near all-time highs. I think they're going to continue to go up throughout the year. So for that reason, I wouldn't forecast a rate cut, but I also don't think it's a big part of the narrative. Last year we talked a lot about it. A couple cuts came in, but largely that wasn't really the narrative for how the year went.
Well, that's interesting. That's the conversation we've been having this morning, especially, and for the past few weeks. Margie Vitale kicking off our show saying that it's not the Fed that's in the driver's seat. So if that's not the catalyst, what are you looking to drive the narrative and push the narrative in these markets from here?
Really, I think it's the advice we've always given our clients, right? I mean, staying invested, right? Looking for the right diversification in our portfolios, more of a solution outcomes, a mindset from before. The introduction of alternatives in your portfolio. I think it's kind of steady as she goes because we're still seeing tremendous cash on the sidelines. That cash
$7 trillion worth.
Yeah, and by some estimates, it's the real liquidity in the market is a lot bigger than that as well. And I keep saying, look, that money in motion has to start coming off the sidelines. More recently, it's really come into the more kind of passive strategies, but I do think you're going to see more room for active management, especially because you're going to see more volatility, which is good for active managers.
I mean, we look at the money market funds all the time.
We do.
I've been doing this job for 25 years. Cash on the sidelines is a mantra that never gives up, right?
Yeah.
Meanwhile, we're fully invested. Retail investors, by a number of Fed surveys, are fully invested. The institutional investment is at a high. Foreign investors are, fully in this market. Where does the marginal investment dollar come from?
Well, one, I think institutional investors are fully invested. I think on the retail side, I don't think that's the case. I think there's still a lot of cash and money coming into that market. But look, it's kind of changing demographics, more active. You're seeing what's happening on the retirement side with 401ks. You're seeing a lot of asset managers going from what was largely an institutional kind of driven client channel to have a lot more interest on the retail kind of wealth segments.
When we started this show, Sally Krawcheck came out and pointed out that Boomers have $75 trillion in wealth that they're shifting right now.
Yeah, to women specifically, too.
Yeah,
a lot of it to women, yeah.
And that's probably one of the biggest wealth transfers is the shift to women. And again, you're going to have a different demographic of people who are making buying decisions and with their money.
So one thing that I find interesting, whether you're talking to kind of the next generation Robin Hood crowd, or if you're talking to JP Morgan, which filed this morning for an interval fund for private credit for the first time, you are looking at more investors in the retail world on all spectrums looking at private assets. One question I have, I think this is right for your heart here, Matt. Do you see fee compression? Because if these are becoming much more widely available assets and you have hedge funds still charging 3 and 30 and then some with pass-through fees.
Pass-through fees. That big take that we had was just rage bait. Yeah.
Yeah, and honestly, frankly, a lot of people worried about some of the returns coming down as some of these offerings are becoming more available, like in private credit. How do you make it more available without demanding lower fees?
Well, look, I think that's the natural order of our markets and really all things and all products, right? Like, I think it's a good thing that things like private credit are more readily available to individuals. I think the individual today is, versus institutions, massively underallocated to alternatives from a correlation benefit perspective. But the more access there is, yeah, there's going to be fee compression. And by the way, of course, the more liquid a private asset class becomes, correlations come under, but we've seen this through other asset classes. Think about real estate, right? Once upon a time, you owned a building because you needed to put people in it, right? I think today, just about anybody can go to a broker and get exposure to real estate. Guess what? Those fees for managing real estate have come down. The correlation benefits of them on a public side have also kind of, changed. But it's just a nitro cycle. But we're still early in the democratization of alternatives.
Right. So that timeline is important there when it comes to that fee pressure. I do want to go back to what you were saying, though, about cash on the sidelines, because it really feels like for those active managers that you speak about, that is the most urgent question. How do you get people out of cash? And Jose, if we're in a year where maybe the Fed doesn't cut at all, there's some talk about a rate hike. We don't need to go there. But if rates don't come down at all, what is the impetus to come out of cash when I can still get 4% in a money market?
Now, look, it's a very good point, because cash today is actually a good investment and has been. Yet look at the market returns, right, over time. Would you have been better staying in cash or being invested in the markets? I think you would have been better investing in the markets. And I think, we manage a pretty large wealth business. That is why having advice for people is important, because you could sit there and go, gee, 4% cash rates or even 5% cash yield at one point seemed pretty attractive, especially from a risk return perspective. Yet the markets outpace that, right? So today, if you were that individual who were invested, like, the markets moved away from you. That is a loss of buying power that you have. And you're already coupling that with what is a massive retirement crisis in this country. Look, I think these are the kind of things that are really important to get the advice to people that say, look, getting invested is where you're going to be better off in the long term.
A retirement crisis, not something we talk about enough here. We do have to leave it there. Jose, we thank you so much for joining us here on set. That is Jose Minaya of BNY. And you can catch more interviews like these at Bloomberg Invest, live in New York on March 4th and 5th. It is finally just around the corner. Get a front row seats to conversations with Carlyle CEO Harvey Schwartz, Soros CEO Don Fitzpatrick, Bridgewater CEO Nir Bardea. Register your interest to attend at bloomberglive.com/invest. Plus, we sat down with Purnima Puri of HPS Investment Partners and asked her what she thought the next big risk is to markets. You can see interviews of Bloomberg's next big risk on the Bloomberg Terminal and on Bloomberg.com.
There's a lot of risks that people know about, which are deficit related, debt to GDP related. I think underappreciated risks are related to growth, and within growth, could we have a labor shortage? That's what I'm worried about.
Let's get a look now at high interest, what's making headlines around the world. TikTok is available again to download in the U.S. after Apple and Google restored it to their app stores. The decision follows a letter from U.S. Attorney General Pam Bondi saying that a TikTok ban would not be immediately enforced. There's still no guarantee that it will survive in the long run, but of course Trump ordered a 75-day review period after his inauguration. People are still buying Birkin bags. Hermes sales surged as wealthy shoppers splurged on their handbags over the holiday season. Sales exceeded expectations, jumping 18% in the fourth quarter. Hermes outperformed its peers like LVMH and Gucci owner Kering as it retained strong pricing power and demand among the wealthiest consumers. And Starbucks is set to open 500 stores in the Middle East in the next 5 years. The chain is looking to bounce back after challenging conditions and consumer boycotts. The new CEO, Brian Niccol, telling Bloomberg's Jumana Bersecci about the damage to the brand caused by that activism.
The boycott and that whole information cycle, it's really unfortunate because obviously it hurts the brand, it hurts our partners in the stores. And the thing that's really disappointing about it is it's just not based on anything that's accurate or true. We've never supported any militaries.
And Starbucks has had a great start to 2025, higher by about almost 25% on a total return basis. Really interesting turnaround story there. Let's get a check on these markets, though. We're a little bit higher right now, about an hour into the U.S. session. The S&P 500, the NASDAQ 100, higher by about 0.1% to 0.2%. We're looking at some pretty healthy weekly gains on the S&P 500, up about 1.6% for the week. The NASDAQ 100 is your leader, though, up about 2.7%. Now, coming up, how will President Trump's tariffs hit the Canadian energy giant Enbridge? We'll ask the company's CEO, Greg Ebel, next. This is Bloomberg.
Enbridge is hitting an all-time high today after the Canadian energy giant maintained its guidance for the year, on a total return basis, I should say. Just what kind of impact is the company bracing for as a U.S. tariff threat ramps up, if you believe that is the case? Joining us to talk about it now is Greg Ebel, Enbridge Energy CEO. Greg, thanks for coming on the program. You know, it seems like the market is developing an immunity to these tariff threats, right? Because they keep being pushed back for studies or after negotiations. But how do you deal with the, as Jim Farley of Ford said, the cost and chaos of it?
Yeah, you know, Matt, look, I think you have to try to focus on the long term. You know, energy infrastructure isn't built overnight, and it definitely is there for 75 or 100 years, and that's what Enbridge has been doing. So there is a super interconnectivity between particularly the United States and Canada, and obviously all the states and provinces. The energy's got to flow. We go by 90% on the liquid side of refineries in North America. We move 20% of the natural gas. So focus on those long-term fundamentals. We need more energy, and we need more all kinds of energy. And if you're a deliverer of energy, you know, we like to say we're a bit like the FedEx or UPS of the energy sector. We'll pick it up and drop it off. You can't get too carried away with short-term gyrations between countries. We don't want to see tariffs. I don't think that's without a doubt, but we don't see that impacting our business definitely in the near time. You'd need some really sustained changes to make different trade patterns go away. So that serves us. That's why, you know, we've hit our guidance for 19 years in a row and increased the dividend for 30 years in a row.
And you're seeing that in the shares. So you're not super worried about the threat of tariffs right now, but are you making any decisions to tariff-proof some of your businesses? I think about there's this talk about new pipelines maybe to Canada's coast to shield from some of the impact. I know that at one point you had a project called Northern Gateway that was canceled, but have you thought about bringing some of those efforts back?
Yeah, for sure. I would say we're more focused on quick hit, low multiple builds, great returning projects, permitting light. As you point out, Northern Gateway was a project that unfortunately the Canadian government canceled. I'm sure they regret that, but it would be very difficult to bring that project back without looking at those types of things with big legislative change that show projects like that are of the national interest. What we are making sure we do is make sure that our supply chains, we're often the biggest buyer of products, contracts. So, you know, we have a renewable business. So making sure that when we buy solar panels, for example, that the seller of those solar panels to us, that they're on the hook for those tariffs, both known and unknown. So you do a lot of things on supply chains. You go to where permitting can be done quickly. As you might recall, we bought $14 billion of new gas distribution companies in the United States in the last 18 months. Those have been wonderful to have because gas generation, gas utilization is going to be big. So, yeah, you want to make sure you're in the most number of jurisdictions with great distribution of businesses so that you can take these, shall we call them hiccups as they happen on the economic front and show that type of resiliency.
You know, Greg, I'm almost sorry to ask you so much about tariffs, but I'm sure your investors are as well. In your earnings call, you mentioned that refiners and oil producers would share a tariff burden. There has been a lot of question around this, on how those tariffs might hit back on American oil companies as well. Could you provide some more specificity? If you see more significant tariffs that would really impact the energy sector here, what exactly is there about the burden to be shared, and how would that create a ripple effect?
Well, yeah, look, I mean, I think if there were tariffs over a sustained period of time, everybody's going to take a little bit of nick, right? The consumer would, producers would, refiners would along the way. But yeah, look, you're picking up a product in one location and delivering it to another location. But again, I think it would take a very sustained period of time with significant tariffs for that to flow through in a material way to anybody on the energy front. And remember, remember even the discussion of energy tariffs that was on the table and is on the table, I guess, was in the 10% range, which is different than what we've seen in some other products that were more like 25%. But look, I mean, a change in prices, everybody, good old economics classes, everybody seeks rents and everybody wants the other person to play. So in the end, if they came in on a sustained basis, I think everybody probably pays for it a little bit.
Greg, step back and give us a bigger picture look at what you expect to happen in the U.S. or North American energy ecosystem. A lot of talk about nuclear, but obviously that's incredibly expensive and takes at least a decade, I've been hearing, to bring on. There's renewed talk about coal again in this administration, but obviously gas, LNG, oil are still kind of the hottest topics. How does the mix look to you, say, in 4 years?
Yeah, well, look, I think, Matt, where we're going is, and we've tried to structure the company looking at this from a fundamentals perspective, it is all of the above now. As you look at data centers, you look reindustrialization, you look at economic growth, you are going to need all of these forms, right? You're even hearing about a slowdown in some of the coal facilities that produce electricity, maybe running out a little bit longer time. Obviously, natural gas, we're building or have secured 5 gigawatts of new natural gas infrastructure for generation just in less than the last year. You're seeing new solar projects come in. We've just signed contracts with the likes of AT&T and Amazon. That's going to continue to be the case. And yes, nukes, but they all have their place and they all have different time frames. Probably the quickest is, small gas-fired generation, with nukes probably being the longest to be able to do that, and everybody else in between. So what we see is an increased demand for electricity and energy throughout North America, and an all of the above strategy is what you really want to have, both from an economic perspective as a government, but also from a company perspective, either as a provider or as a user.
Well, when it comes to that demand for electricity, let's talk a little bit more about data centers, because this was a topic on your earnings call as well. Basically, what are the conversations that you're having with those data center operators? How much does Enbridge stand to benefit from that?
Yeah, big time. As I said, I mean, we've got a BCF of new pipeline infrastructure, so 1 billion cubic feet of increased demand from data centers and power. So you're seeing two groups. You're seeing the likes of the Amazons and the AT&Ts who might want to actually sign up for, say, solar projects in Texas or Ohio, which we've just done with them, but they also want to have natural gas backup. You're seeing the likes of Duke Energy bring on new gas-fired generation, or the Tennessee Valley Authority, TVA, moving from coal to gas, all to serve things like data centers. So there's two places. One, right in the backyard of the data center itself, or two, big utility producers and sometimes independent power producers who are connecting to those data centers. We get the benefit of both, having solar business as well as having actually electricity business, the pipeline business as well. So yeah, it's on. I don't think it's going away anytime soon. You're going to see much bigger need for gas demand than we've seen for decades, as well as on the electricity front as well.
Right, to that front, there's data centers, of course, as we've been talking about, huge theme in the market right now, but also it's just cold. I mean, I don't know if you guys knew this.
It's always that way in the winter.
Well,
when I was a kid, it was this way all the time in winters.
There's a huge
snow
storm about to come into next week, into the central U.S., into Texas even, and you are seeing natural gas prices spiking pretty significantly on the heels of that. Greg, where do you see prices going? Because there's kind of those near-term weather pressures, as Matt says it is winter, but also just over the longer term here, given that you have added demands outside of just consumer needs.
Right. But now the two things. One, you're right, and it's been a cold start to the winter, colder than we saw in the last couple of years. So that's good for our business. But look, I think gas is going to stay in that $3 to $5 per 1,000 cubic feet range. Like that is a sweet spot. And you might recall, we only have to go back 8-10 years where gas was $5 or $7 for that same unit. So we have an unbelievable wealth of natural gas gas in North America, in the United States, and in Canada. And even with the LNG exports, you're seeing a real price advantage for North American consumers, North American businesses, and obviously the energy infrastructure companies. So I actually think we're in that sweet spot of, call it $3 to $5. And, I think it's tough to get to $5 on a sustained basis, but that $3 world that we're in, I think, is more the logical place. And that is the Goldilocks side of things for gas usage.
Greg, we thank you, of course, so much for joining us today. That is Greg Ebel of Enbridge. Now let's get a look at stocks moving this hour. Of course, a lot moving under the market. Airbnb now up more than 15%. There's an upbeat forecast for the first 3 months of 2025, citing strong demand after a busy holiday travel season. And guys, I mean, it's such an interesting thing to see a consumer-focused stock generally up so much. Of course, we had those retail sales this morning, maybe impacted by other factors, but of course, shaken off in the likes of Airbnb and DraftKings, certainly up more than 12, almost 13% as the market opens.
Yeah, well, we know that people have been paying up for experiences, and I think travel fits into that, as we've seen, and Airbnb is a good example today.
I prefer things to experiences.
Yeah, well, you're not a millennial. Sad to say.
That is very true.
Gratification.
Yeah. That is very true.
All right, coming up, we're going to do even more on the energy industry. We'll take a look at how technology is helping oil and gas companies prevent methane leaks. That's next in today's Wall Street Week. This is Bloomberg. All right, it's time now for our daily Wall Street Week conversation. And methane leaks are a big problem for oil and gas producers such as Enbridge. It's a toxic greenhouse gas that's 80% more potent than carbon dioxide. And detecting leaks can help energy companies become more efficient. Wall Street Week's David Weston has the story.
So here you see a retractable tower, and at the top of the tower is a laser spectrometer.
Caroline Alden is co-founder and chief scientist of Longpath Technologies, a tech startup with a new way of detecting those methane leaks with laser-based sensors. Here in the Wyoming sagebrush steppe, near the foothills of the Wind River Mountains, pronghorn antelope and wild horses roam above one of the largest natural gas reserves in the United States. And the Jonah Field has become a proving ground for cutting-edge technology.
So the laser is going around collecting all its concentration data right up there in that little tiny box. And inside that box is a laser, a detector, and all the computing that you need to crunch the numbers on emissions from any of the well sites you can see around here. This is a kind of a fun place to be as a climate scientist because it's a place we can all kind of row in the same direction. The industry also, doesn't want to have methane emissions. This is their product that we're keeping in the pipeline for them when we catch leaks. And so it's a real win-win where if we can give them data to help them make their operations better while also reducing emissions, that's a win-win for the climate and the industry.
In 2022, the U.S. emitted around 6 billion metric tons of greenhouse gases. Methane made up about 11% of that, but it's a particularly potent and toxic gas.
Methane as a molecule is interesting because compared to CO2, which is the greenhouse gas folks are most familiar with, it's about 80 times more powerful in terms of the warming potential on a molecule per molecule basis.
Its potency makes the market for methane detection technology that much more important. And JP Morgan projects it will be more than $900 million by 2025, with a potential global market as high as $14.9 billion.
I believe this is really going to fundamentally change how operators view leak detection and repair. And I think it will change how regulators view leak detection and repair.
Howard Dieter, Jonah Energy's vice president in charge of environmental health and safety, says his goal is 24/7 monitoring using Longpath's continuous laser system, and then following up using optical gas imaging cameras and validating those measurements with drones, aircraft, and satellites.
I do think that as this technology becomes better, as it becomes more affordable to deploy, that it really is a game changer in how we think about operating and managing our facilities.
That was Bloomberg Wall Street Week host David Weston. You can catch the full show every Friday.